All right, so ladies and gentlemen, welcome to lecture 13 on strategic case study. And here we are going to look at the corporate strategy and diversification. If you remember, it's all under, this will be the second broad thing under strategic choices. And if I take you back to what we did on strategic choices, we learned that in strategic choices, we learned that one, the choices as to how an organization at its business level position itself for competitive advantage. All right. So that one was about choice as to how strategic business units position themselves for competitive advantage. Okay, so if you watch that video, you will see there was another one was as to the choice of direction. If you remember, the choices of strategic direction. And the last one was the method to pursue them. By which strategies are pursued. And we've gone through this aspect of it. That was the lecture 11 and 12. And this will be lecture 13. This will handle lecture 14. All right. So now let's go ahead to understand what corporate strategy, the direction. And I explained in that video that is about the corporate strategy. Wow, this pen is too deep. Corporate strategy and diversification. All right, so in this lecture, that is what we look at. Now, what is this one about? Here, well, pen is very deep. I think all of them. Okay, so here we are looking at choices concerning the different business units. All right. So the different businesses or markets. Where should we go? Now, when I talk about the business, I mean that what new product, so the new product, what we want to do, and which market areas are we going to pursue them in. All right. So corporate strategy is about what business area to be active. All right. The business area to be active and determines which business. So if you want to know the business area to be active in, we want to know which business unit we are supposed to buy, which direction an organization might pursue, and how resources are supposed to be allocated to it. So in terms of you understanding this, we are looking at which business units to buy, because if you want to go into a new market and we want to do something, which business units are we supposed to buy? So the businesses to buy if you are not doing it yourself. All right. The direction to go. Okay. And how you allocate your resources. So if you know all these things, then you allocate your resources towards it. All right. So that is that. So the scope of an organization is very central to its strategy. You remember, when we talk about the scope, we are talking about how diversified an organization is. So your diversification, your scope as expressed in, and I think it's something we have already discussed, the scope as expressed in which product? This one. That is what we refer to as scope. So when we say scope, we are talking about how broad to make the portfolio. All right. So all this one. So let me. All right. We discuss the scope, and when we say scope, it's like what you are doing. How broad, or how broad is what you are doing. All right. So we are looking at how broad to make the portfolio. And when we say portfolio, the various businesses that you can enjoy, you can engulf yourself in. I mean, you can do selling, you can do financial market, right? In terms of diversification, if you remember. So scope is about diversification, how diversified you are. All right. And these things are achieved via two main things. So we are talking about corporate parenting. All right. So how should the parent help the subsidiary, the business that you buy, the various portfolios that you are in? How should the parents? So we are looking at the parents adding value to you. All right. Adding value. So we will look at the portfolio manager, the synergy manager, and the parent developer. Something that you see clearly in your syllabus. So we will look at the portfolio manager. We will look at the synergy manager, or in the context of adding value, and we'll look at the parent developer. On the other side, we are looking at the portfolio matrix, and that is where some models come in. All right. So this is all about which business units should we invest in? Which business units should we invest in? And here we are going to do the BCG matrix. All right, the Boston Corporation. We will look at the McKinsey direction. We will talk about parenting. All right, so these are the things that we are going to discuss in this video concerning the corporate strategy and diversification. All right, so let's go deep into it and discuss what we need to do over here. All right, so that's that. Now, so we are looking at our strategic direction, where we need to do, which businesses to do, and and the direction we are supposed to take to achieve growth. All right. So which areas should the entity grow in? That's all these things. That's what it's about. So when you look at the corporate, so here already, like I've discussed with you here. So which business should we engulf ourselves in? All right. So we are looking at your strategic direction. All right. So that is what this place is about. If you remember what I started, your strategic direction. All right. So where you want to go. So let's discuss it. Strategic direction. It is also called your growth strategies. All right. Your growth strategies. And as discussed, we are looking at which areas should an entity grow in. All right. So which areas? Should we grow in, i.e., which business unit should we? And the framework we use to discuss this thing is the ANSOF. All right, ANSOF product because end market growth, and that is it. Everything we are doing, we said what business to do, which means the new products to bring in, all right, or to innovate on, and also the market. So we use the answer here. All right, it's one of the things, the powerful things. Now, answer talks about 5 basic direction and organizational growth. So let's look at the answer that what the answer help us to do. So I'm going to use. Let me use. Okay. Good. So the answer, we have the products here on this axis. Then we have the market. This the market. Here, let me make here existing, new, existing, new. All right, so that is what we are trying to look at. So when you have an existing product in an existing market, what do you have to do? So what you have to do is termed as market penetration. You are already there. So the essence of market penetration is to increase your share, your market share. You want to get market share. And why that? Because you need to increase your power. So if you are there, and how do you increase your market share? Before that, so you want to increase your power over the buyers and the suppliers. You remember the Potter's 5 forces. You remember. All right. So if you have large market share, you have monopoly. All right. And monopoly against your suppliers and monopoly against your customers. All right. And how do you achieve that? So to increase these ones, some of the things that you have to be doing is to increase your advertisement because you're already there. So make your presence known, increase your advertisement to get new customers. That's the target. All right. But for the existing customers, visit them. Visit existing customers. All right. That is that. And try and win rival customers. Win their customers too. All right. And you can only win them by cutting costs. All right. So you sell at low selling prices. All right, and increase your quality. But the thing is that immediately you go into these things, you face what we call retaliation. As you do, they do. All right, you face retaliation, and sometimes too there is legal constraints on exploitation. All right, that is that. So at this point, if you feel like the reverse is against you and everything, you are not able to do it, you can actually decide to actually retrench. Okay, sell out. All right, you can actually decide to sell out. We call it retrenchment. Okay, so when you do the retaliations and all those things, the retaliations and everything is against you, and just leave the market. That's all. Here, when you have new products, what we call it in new market, and you with your existing product, what you have to do is that you use your existing product to go into a new market. So here what we will do is to do what we call market development. Market development. So you use your existing product to enter into a new market. All right. And here, what you are supposed to do is that you have to kind of get new users. All right. So this is kind of a geographical diversification. That is what is happening. And so what you're going to do is that you need to find new users. All right. You are finding new geographical areas, a new market, but you have your existing. So let's say your product selling in Ghana, you want to enter into a new market like UK. All right. So when you are going, you need to target, all right, you need to target specific kind of demographics. So let's say when I go, I'm going for the youth, all right, I'm designing my product for the product I'm having here, I'm going to sell it to the youth. All right. So we have what you need to be careful is what we have learned. So you have to do pestle analysis. You have to do the Potter's diamond if it is international. All right. So you have to look at it from this perspective. Okay. So you have a product, you are using it to enter a new market. Because when you are going, what some of the things you must make sure to do, some of the things that you must make sure to do is to enter with low price. Because you are now going to enter into a new market. You are going to enter quality product with quality product at a very low price. At a low price. But when you are going, check these things. All right. So take note of that. All right. So for having a new product, let's say you have a new product in an existing market, is about product development. Product development, delivering modified or new product in an existing market. That is what it is about. Delivering modified or new product in an existing market. So, do you know what the iPhone people do? They have the Apple, they have the iPod. So, the same customers. So, they have their customers ready. All right. So they bring out additional products into ADAP. So now, because of the iPod, everybody who is using iPhone wants an iPod because they already have existing market. So they come with new products or new modified innovative product. All right. So that is that. But here you have to have how you go about it is that you have to have new resource and capabilities because you are coming to do something new. All right. I.e., your R&D, research and development thing should be high, but you also have to have some idea of project management risk. Yeah, very, very important. All right. That is that. Because this thing can lead to what we call a cannibalization of existing products. All right. So take note of that. Take note of that. But for a new product in a new market, that is what we call it the conglomerate diversification. Unrelated conglomerate diversification. Purely unrelated. You're offering new product to new customers. All right. So new products to new customers. Is that okay? And because it is about new product, every time you hear something new product in your case, think about resource and capability. You remember the VRIO analysis, all right, and project management. When you hear of new customers, it means you are entering a new environment. The pestle and the diamond, all right. The diamond is used when you are going international. Okay, so that is that. That is that. All right. So take note of that. So we will look at this thing in details. All right. So take note of that. Okay. So that is it. So you can grow by doing this hands-off, all right, in the relationship of the hands-off. You can grow in existing market. When you are there, what are you supposed to do? Increase advertisement, all right. If you want to grow, and every business wants to increase advertisement, visit your existing clients, win new ones over by reducing your price, all right. When you are having existing products, you want to enter into a new market. So in the case, look at it in that dimension, then it means that it is about market development, and therefore you need to bring in your potters and the best. The diamond is used, all right. So when you are entering an international market, a new geographical area, all right, like international, so you use the diamond. We've already discussed the diamond, right? So take note of that. All right. So that is that. So you can use this model, all right? You can also decide to grow. So this one, we are coming to look at this one, look into this one into detail. Growth by diversification. We want to grow by diversification. So let's look into it. Growth by diversification. We have growth by advertisement, increasing your market share. All right. We have growth by entering into a new market with the same products that you have. You have a situation whereby you have a new product, but it is to your existing customers. But we have a situation whereby the product is new and the market too is new. So we are looking at growth by diversification. Diversification simply means not putting all your eggs in one basket. You diversify between unrelated. Uh, um, Sometimes it can be related, sometimes it can be unrelated. All right, now, and so there are three diversification approach that we are going to look at. We are going to look at what we call the vertical diversification or the vertical integration. Vertical integration. Then we will look at what we call the horizontal diversification. And the conglomerate diversification. All right. So these are the things that we are trying to. Now, when we say vertical diversification, what does it mean? We are looking at a situation whereby existing activities of an organization, you integrate them. All right. So the vertical line is like this. So when you have people who are on the same supply chain, okay, so the supply chain. So so you are integrating existing activities. So you may be here, you are trying to integrate everything together. All right. So here you are just entering activities where your suppliers and your customers are. All right. So that is that. So as you are trying to own your supplier, you are trying to own how you get to your customer. So that is that. That is that. So it's all about entering the activities where an organization has its own approach to supplying and delivering to customers. All right. So per this definition, we can have what we call backward integration. So it simply means acquiring your supply base. Why are you acquiring your supply base? Because you want to avoid delays. You want something, your supplier is delaying you, but if you are your own supplier, there will be no delays. You also want quality. So it's to avoid delays, have quality, and have economies of scope. So reduce your cost. All right. So that is that. But in as much as you are reducing your cost through economies of scope, remember that there can be operational gearing. You have to spend capex, right? So that is the backward. Then we have the forward. So the forward integration is acquiring your distribution base. So you acquire your distribution base so that you can meet the timelines to your customers. Imagine you are selling something, you need somebody to deliver. A customer has bought something, you need somebody to deliver. Then the delivery people are delaying. Now, if you own it, then you do it yourself. All right. So that is that. Now let's talk about the horizontal diversification. That one too is simple. What it means is that you are going into the activities that are competitive or complementary. What do I mean by that? So those people who are you are on with the same supply chain, you buy them or merge with them. So what happens is that when you do that, you increase your market base. So we can use horizontal to actually do what here, the market penetration to increase your market size. All right. So you can acquire businesses. So you can acquire your competitor. So you own his customers as well. All right. So that is that. So that is you developing into activities that are competitive or complementary. So you are buying your competitors. All right. Basically, and you grow by that. All right. So that is that. So those people that you compete with, the people that you compete with, those are the people that you are buying. All right. So that is that. You buy it. And what is happening is that will give you synergy, to give you market share, to have power. All right. And you'll be able to defend yourself against your substitute. But the disadvantage is that it's very difficult to manage. All right. Very, very difficult to manage. And you have to have new strategic needs for that. But when we talk about the conglomerate diversification, it is unrelated. Remember, we said new product, new market. It's all about trying to avoid what we call the systematic risk. All right, the industry risk. So if you invest all your money at one place when the risk can be caught, right? So that is that. But what makes people diversify? Why do you think somebody will go into diversification in all these things that we are talking about? As you can see, the reasons for the diversification, which we call drivers of diversification, they are simple. Why do you think people are doing that? Number one, clearly, they want economies of scope. Economies of scope. What do we mean by economies of scope? Synergistic gains. So you buy, let's say, let me say, those who do the ideal milk, carnation milk, you buy it, you own the entire thing. All right. So you can use that opportunity to actually get synergistic gains through economies of scale. You reduce your fixed costs because fixed costs are fixed no matter how much you produce. So it will help you to manage your fixed costs. All right. So that is that. That is that. And also, uh, it helps you to stretch your competence. So stretching your corporate management competence. Now you become big. And that thing, stretching your economic management competence is called economies of talent. Economies of talent. You are stretching your management capabilities. All right. Basically, that is that. And it is to increase market power. Increase market power. So people do that for a whole lot of reasons. All right. Yeah, that is that. But the thing is that these things, if you're not done well, it can destroy you. Can destroy you. Managerial ambitions of empire building. You are just responding to some deadlines or spreading risk. All right, it can affect you. It can affect you. And so when you do these things, you need what we call the corporate parenting. You remember the diagram that I drew, the corporate parent. You will need it because you will need support and guidance in those things. All right. So we said that to go through this, remember the diagram that I drew for you, this one. All right. You need to get some corporate parenting. All right. So what is the corporate parenting about? The corporate parenting is all about adding value to your subsidiaries other than cost. Adding value to your subsidiaries other than costing them. You know, some head offices, what they do is that they will add some cost to you via what we call the cost. We call it value destroying activities, the cost part. Value destroying activities. What do they do? What they do is that you see management fees, you see them coming from head office, some bureaucratic complexities, delaying things. They delay things for you, all right, and they obscure your financial performance. But corporate parenting, the value adding activity is to help you envision. They need to give you vision, all right? They need to coach you, the subsidiary, okay? They need to intervene in terms of any help. And when they do that, they are adding value to you, facilitate synergy. And those things they do to add value to you. That's corporate parenting. Corporate parenting. So what I want to do is to discuss some corporate parenting rules. If you saw, we have the portfolio manager, the synergy manager, the parental developer. What are all those things about? So let me pick it up here, okay? Because when you are doing this diversification, you need them. All right. How broad you want to do corporate parenting? The rules. All right. So I'm going to look at what the corporate parent is supposed to be doing in terms of these three. So we have the portfolio manager, we have the synergy manager, and we have the parental developer. These are the activities of corporate parenting. What are they doing? So one, let's look at the role of the portfolio developer. So we are these guys, what they do is that they are active investors acting on behalf of shareholders to extract value from businesses. So various businesses that you have, these are active investors. And what they are doing is that they are doing agency work. They are acting on behalf of owners. And what they are doing is to extract value, create value from businesses. The strategic business units. All right. So their main focus, therefore, is to identify businesses. So they identify undervaluing businesses, struggling businesses. They acquire them, improve them, and divest them. That's what they do. That's what they do. So the value they create intervening into the businesses. All right. That's the value they create. They intervene in businesses, struggling businesses. So the strategy here is not focused on relatedness of units, no, like we want to be. So it's purely conglomerate. So that's the strategy. It's purely unrelated. You are looking for any form of business at all to create value by intervening in those things. All right. And making them better. Okay, so basically that is that. So if you see those private equity firms, these are typical examples of them, private equity firms. They invest in small businesses to make them worthwhile. All right. The challenge is that there are fewer opportunities due to financial risk, but that is what they do. A synergistic manager, rather, he is looking like integration, already related entities, those who are on the same supply chain. So here the focus is really kind of looking at business that are related so that they have shared values, right? So this one looks at related businesses so that they can cut costs through synergy. So you have reception in this place, reception in this place, in the same building, different company, then they take away one reception. Right? So these people, their role is to create value through synergy. All right, synergistic efficiency, not duplication. So wherever there is duplication, they take them out. All right, so that is what they do, and this is for large corporations. They are actually of large corporations, so they want to combine, so consolidate and cut off any duplication. But a parental developer add value by transferring skills and capability from the head office to assist the people down there. All right. So that is that. They create value by transferring transferring resources and capabilities. All right. So you see that some people come from head office to assist the business. Right. So basically that is that. So their focus is rather to develop the SDUs using unique strengths. All right. So they support with strength, unique strength. So they find out what you need and they come there to help you. They provide guidance, they give you resources. All right. So that is what they do. That's how they create value. Providing guidance, giving you resources. They help you, basically. They help you. All right. So that is that. The challenge in the portfolio manager, like I said, portfolio management is about the financial market, the risk. But when you look at the synergistic, it is all about breaking excessive cost of integration. Excessive cost of duplication. And so what you are going to do is that you are going to integrate to cut all the costs that are there. So what happens is that most often you will have some behavioral aspect of managers competing themselves. Right? That is basically what happens. Right. So that is that. But parental developer, calm down, assist them. All right. So that is that. Add value come and assist them. Sometimes these things involve even outsourcing some people to come and help them, right? So basically that is that. Okay, so that is it. Now let's look at the other side. I did a triangle. I talked about the scope, how you can go parenting and what the portfolio matrices. So let's look at the portfolio matrices. That's the last part of this aspect that you are supposed to put it. So what are the portfolio matrices? I said we will learn about the BCG matrix, right? Okay, so that is that. So the portfolio matrix, portfolio. So corporate parenting is for corporate parenting in multi-business organization. All right, how you do that. So we are going to look at one, the BCG matrix. We will be looking at two, the G McKinsey matrix. And lastly, the parenting matrix. Now, all these things, matrix, helps you to balance portfolio. All right. So the essence is to balance your portfolio so that you can have different SBUs, all right, at the same time working. And we are looking at the attractiveness and its strategic fits. All right. When you say attractiveness, the profitability. Profitability. And is it fit for strategy? Strategic fit. Strategic fit. All right, so basically that is that. So let's look at the boxing box or the product portfolio metrics or the BCG metrics, the same thing, all right? It's the same thing. Now, what this thing, the BCG metrics is that it analyzes portfolio balance using market growth and related market share, right? Relative market share. So let's look at the BCG. All right, it's also called the boxing group or product portfolio metrics, or it has so many names. Okay, so um, but what is it about? We are balancing your portfolio, all right, the product you want to, for using your market growth rate and relative market share. So it is relative market share, not market share, relative market share. It means if your market share is 10 and the competitor is owing 50, it is 10, 50 out of this is giving you your relative, all right, market share. That is that. So sometimes some questions they may ask you to calculate all those things. All right. So the same thing we did for the answer is what I'm going with. All right. So I'm going to use this side for market growth. And the top will be relative market share. And we have this side to be your high, your low, high, your low. High is where you have your stars. It means you have high market share with high growth rate. And so what do you do? High market share with high growth rate. So what do? You require heavy investment to be market leaders. Okay, so that is that. That is that. It require heavy investment. That is that. You are so you are market leaders, and it generates cash. These ones generate cash for you. They generate cash. All right, but the money that you get needs to go into improving your maximization of the market share. All right, so that is that. That is that. All right. So what you see here is that here the cash that you generate is equal to the cash you consume. Basically, that is that. So cash is needed for rebranding for your future cash flows. So you need cash for rebranding, and that is that. So what happens is that what you see is that the money that you will get goes into you sustaining your market leadership. So it requires higher investment because high market share with high growth rates. So you are going on top like that. Then here we have the low relative market and expectancy of market growth is called, we have the question marks. The question marks. Question marks. Now, here you have low market in a high growth. You have low. The entire general industry is growing. So here the industry is growing, as you can see. Industry market is growing, and you also need to grow. You also grow, so you require investment so that you can stay as a market leader, and so therefore all the cash you generate goes back like that. But if you have question marks, we call it, or we also call it the problem child. The problem child. All right, problem child. Now, what does it mean? It requires you to actually bring cash into it more than you generate, because you don't know whether the thing is going to, I mean, um, work. You are in doubt, all right? You are in doubt. And so those ones, what happens is that you see that the cash generation is less than the cash you consume. All right. Why? Because you want to make the project get to become a star, as you can see. But if it is not able to, I mean, get to the star position, then it means it is going into dogs. What do we mean, dogs? It means that you have low market in a low generally growth company. And here too, as you can see, the cash generated is equal to the cash consumed. You have low market share, and you also have, so like a diagonal sort of thing, right? Diagonal sort of thing, the opposite. All right, diagonal. Now you see that it is a dog. You have low market share, you too you have. So normally what you do here is that you may even liquidate. It is not worthwhile, but you might have to stay because probably it's providing complementary services. Here we have the cash cows. The cash cows. What does that mean? Market growth, the entire market growth is declining, yet you still have higher market share. All right, because because of the low growth rate competition, you increase. All right, and this cash is needed to compete in this one, because the way the market is declining and you still want to stay on top, and it is generating you more money, it means that you need more cash. You advertise, you do R&D, you invest excess cash that you get. All right, so the excess cash that you get will go into your stars to help boost those places to come and also bring them into cash cows. All right, so that is that. So here what you see is that the cash generating is greater than. Why? Because as the market is falling, you still remain a market leader. All right, so that is that. That is that. So this place is about the industry's attractiveness. Is the industry attractive? So that is what we call the market growth. All right. So if demand is growing, then it means you need asset. If the market is growing, it means you need asset. You need to make investment to stay on top of it. All right. So basically, that is that. Other than that, if you don't take care, you will go into this direction. So every excess cash you get over here, please make sure you invest into your stars to also bring it, all right, to the level of a cash cow. So that is that. You can also relate this. So this BCG matrix is to help you to know. The aim is to help you to know where to allocate extra resources, where to cash out. So cash out, where to divest, all right, in the at the corporate level. So that is what you are doing. You can link the BCG matrix to the product life cycle. If you remember that thing, which is drawn usually like something like this, all right. So where you have the introduction, you have growth, uh, maturity, and decline, where it declines. So the introduction of the thing is the question mark. You really don't know how it will perform as it is growing to see your stars. At maturity, you have your cash cow, and when it is declining, you have dogs. Because at the dogs, you have to still invest more into marketing and everything. Problems about the BCG matrix is that it is hard to define what counts as a high and a low market. So we call that in definition vagueness. All right, that those are the issues. Number one, the issues of is definition vagueness. What do we mean the market is low and the market is high? Is vague. All right. And also it assumes funding comes from internal sources. It doesn't assume you borrow money to actually do better. So the thing is that it has a capital market assumption that says that you are using your retained earnings, but not all the time. Sometimes people must uh, use external because listed companies, they can float shares, all right. So that is that. Then the treatment of the SBU as cash cows, so as the only source of fund, that is not true. All right, it's not always true. So how you treat the SBUs? The dogs are typically discarded. Now, what happens to those people that are working there is demotivation to classify them as dogs and all those things, and it ignores commercial linkage, right? But you see, in every business there has to be one that is doing well, others to support the other, so that to provide complementary services so that you can function. You cannot say it is not working, so everything should like that, right? So uh that is that. That is that. Now, the two that we are going to discuss, the remaining two that we are going to discuss, is the the McKinsey matrix, the directional policy matrix. All right, that is 9, not the McKinsey. The other one we will do it at implementation, strategy implementation. The 7, we do it as strategy implementation. Now, so this is what I'm going to do. Let me bring out this book. Let's analyze it. All right, so as you can see on your screen, this is the directional policy McKinsey metrics. All right, the 7-point McKinsey evaluation skills, we will do it in strategic implementation. So here, what you are seeing is that we talked about definitional vagueness. And so this one gives a 9 cell, not just for 1, 2, 3, 4, 5, 6, 7, 8, 9. All right, a 9 cell directional policy matrix, so that we can have the possibility of a middle ground, because that is something the BCG matrix is not able to give us. All right, it's either you are cash cow, question mark, dog, then or a star. But the axes here are not based on a single matrix like the the BCG matrix. So it addresses the problems of the BCG matrix. And so here we are looking at what you saw in the BCG matrix was market attractiveness and the what do we call it? The um, market share, which is the relative uh, market. All right, so that is that. So you have the market growth and you have your market share, your relative market share. But here we are looking at a broader perspective. Now, so the categories here is that we are not looking at, so here we say we want the good product and the less good product, all right, in offering strategic guidance for you to position yourself. All right, so it suggests that a business with the highest growth, all right, highest growth potential and the greatest strength are those ones, the ones that you should invest in. Okay, so that is that. It is more complex than the BCG matrix. So it has 9 cells. All right, so here you have the business strength, which is based on competitive advantage. So is your strength strong, average, or weak? So there's a middle ground, unlike the BCG matrix you don't have. Then we have the market attractiveness, which is defined by, so please, the here one, we have the market attractiveness. And in the BCG matrix, that was the relative market growth, all right, the market growth, the industrial growth. Here, the attractiveness is determined by Pestel and the Potter's 5 forces. That would tell you whether the thing is attractive or not. That place was more of profitability. Now then the business strength that you see here, the SBU strength, is your competitive position. All right, where is your position? Are you leading? Are you in the middle? Or you are weak? All right, so that is that. So what do you see? You see these ones. Please know the map represents size of the market. So this is the size of the market. And relative market share of the SBU, your competitive advantage. This is where you are. So this is where those are. Now, if you find yourself here, high, strong, you grow. Here, you grow. If you are weak, you hold. You hold. All right. So here also, what do you see? You have market share, the market share of the SBU, look at it. So if this represents the size of the market and you are having this share, what does that tell you? There is more room for growth. All right. So this is it. Your share of the SBU, there is more room for growth, as you can see. All right. And here, as you can see, this one represents the market. All right. So that is that. But here, you don't have anything. So you hold. All right. So that is that. This one too represent what we call your harvest. All right. The harvest, the harvest. When we say grow, what do we mean? So we say that these SBUs have the ability to bring in high returns. So when we say look at the position, strong market, you have medium. There is such, you need to invest in research and development, advertise, in branding and everything. All right, so you have to grow. All right, so that is that, because you have space. Like this is it, the market is attractive long term, you have strong competitive advantage, you grow. But where you are weak and the market is also less attractive, then what you need to do sometimes is to hold. All right, is to hold. Okay, so that is that. When we say hold, what do we mean? We are saying that you have the potential, but your position is not clear for you. The position is not clear. So that is where you hold. Invest in those ones with strategic purpose. If you don't see it, then the harvest part, the part that we say we harvest, if you are an SBU, you may not perform in a less attractive market. So invest in only those you break even, so you can divest. All right. So that is that. So basically, here, if you are having strong competitive position, growth, I mean, the market is attractive. Grow. That is that. If you are in a medium position, grow. If you are strong, but the market is not unattractive, it is not clear for you, so you hold. That's what we mean. So that is that. So that here too, you can decide to hold. Now, if you see this one, it is a weak, you are weak in the competition, and it is also a low, you can decide to harvest. And when I say harvest, I've explained it to you that you may not perform in that less attractive market, so you divest, like the BCG matrix, the docs. All right. So that is that. Unfortunately, this one to have a definitional vagueness and the capital assumption too. And as you classify, you may also be discouraging other people. All right. So that is it. That is it. Okay. That is it. So it is said that some of the averages you must have to face some form of like try and withdraw from it. And that is what we say hold. Okay. And sometimes harvest. That is that. Then the parenting matrix also looks like this. That's how the parenting matrix also looks like. All right. That's how it also looks. So look at it. It's also it's all about, the purpose is to assess how a corporate parent, all right, fits, how well a corporate parent fits with its SBU, on its ability to understand and add value to the SBU. All right. To understand is what we call feel. All right. That is what we call feel. What is the feeling? Do they understand? How well does the parent understand the SBU? We call it feel. Feel. Okay. So this part is what we call feel. Then the top, this side is called the benefit. What we mean by the benefit is the degree to which the parent can add value. You can add value by giving them bulk. I mean, if you have a company, a branch is going for a loan without the tops backing, how much can you get? You don't get much. But if you have corporate backing, you can get anything you want to get because corporate is big. All right. So that is that. So this field reflects the managerial competence and familiarity. All right. How well they understand the business. All right. So basically that is that. So look at it. When we say ballast business, what does it? What does it? It simply means that the have you seen this portion? It is low. Okay, it is low. It means that and this side is high. It means that they feel they understand the business. All right, but the support they give is low, very, very low. All right, so that is that. That is that. So that is the situation it describes. Then the alien business means that um, the support is low and also the understanding is low. So that is what we mean alien business. Okay, so you really don't understand your SBU. The heartland business is showing a situation whereby they feel they understand, the feeling is there, and there is also the support. All right, so that is that. So you focus on future growth. right? But the other side of it is that you also have what do you call it, skills and everything, but the understanding is low. You have it in abundance, but you don't understand it. So it is risky. It is risky. You putting in resources into something you don't understand is very, very risky. Right. So that is it. These things doesn't make much in your cases, but it's just that you have to have understanding. All right. So, ladies and gentlemen, what you learn here basically for your exam purposes is about the dimensional aspect of the parenting, the portfolio manager, synergistic manager, all right, and the uh, uh, parent developer. But most importantly, the concept of the BCG matrix and this side where we discuss vertical integration, horizontal integration. So the next time we in lecture 14, what I'm going to do is I'm going to discuss acquisition and merger. All right, acquisition and merger strategic alliance. That's how you do the strategic direction, how you implement it. So basically that is that. So that is what we will be discussing. All right. And then we will now move on to the implementation. That is where everything happens in the exam, the implementation. All right. So thank you.